I'm Jeff Huzak, and welcome to the July of 2021 Market Update webinar. So let's get started. So obviously, quick intro slide there, who I am, 2 professional designations, 16 years in the securities industry, manage money for individuals, families, as well as small business and corporate retirement plans. Here is the disclosure slide I have to leave up for 10 seconds or so with the list of states that we are currently registered to do business in addition to all of our contact information and my email address there on the bottom. Topics to be discussed today. So really quick, bullish, bearish argument, not much changes on that month over month. I'm going to look at interest rates, inflation expectations, commodity prices, the S&P 500 at all-time highs, but, kind of a lack of participation there. And I'm going to show that in regards to, the S&P 500 versus the S&P 500 equal weight. We'll look at growth versus value, credit spreads, and then high yield versus treasuries. Just some different changes there going on with growth versus value and high yield versus treasuries right now. So bullish arguments, bearish arguments, earnings still coming in pretty strong, but that's expected with how depressed everything was. Obviously global asset shortage is, one of the things I've mentioned in the past and is kind of keeping the market propped up a little bit. Low interest rates, I think a lot of people with when commodity prices started to spike, inflation fears, people thought that the Fed would step in and kind of, raise interest rates. I don't think they'll do that until maybe the latter half of 2022 would be kind of the earliest. So I think we're still okay there. Credit market's not really signaling any issues right now in terms of credit spreads. And, the market's resilient. I mean, it keeps shaking off any sort of negative news and continues to kind of inch higher, but it's not really as strong as people think when you really kind of look under the hood. Bearish arguments, U.S. equity markets are maybe a bit stretched. Everything going on with inflation, the concerns there. I've said in the past, I thought the inflation trade was a little bit overdone over the past few months. So I don't think there's a whole lot to be concerned with there. It's just, I think that's kind of what the general public, is talking about a little bit in the background. Signs of reckless investing, similar to 2000 bubble. I've mentioned that in the past as well. Just a lot of people investing in stocks thinking they can make, 100, 150% in a short, time period, and that it's super easy to do so. And it's just not the case. Seasonality, obviously summer months, historically speaking, seem to be a little bit more volatile and more difficult for the markets. And we're, into that at this point, and then weakening breadth. So participation. And that's kind of where I talked about, where yes, the S&P 500 is making new highs, but it not really all as strong as it may look from the outside. So first thing I want to get into, TNX, right? So this is a 10-year note. This is the interest rates, so off of 10-year treasuries, bonds. And you can see, right, so this is coming down here, which means bond prices are going up. So this is, the 10-year, the interest rates off the 10-year note. And, as inflation started to kind of take hold, inflation expectations and things like that, interest rates were kind of creeping up quite a bit. And they kind of peaked. They're starting to come down here. And this is what made bonds such a difficult, asset class to be in. Specifically, this year, kind of going back to like last October, as interest rates, as interest rates go up, bond prices go down and vice versa, right? So this is why bonds have actually gotten, pretty good bid here over the past few months. Treasuries have really started to turn the corner. That it can be a good thing, but that could also mean that maybe there's some things kind of in the background with the market with treasuries as a risk off asset class, maybe signaling that there might be some difficult waters ahead. So I just think a lot of people thought interest rates were going to continue to spike based off of how much inflationary issues because of how much money printing is going on and things of that nature. And as of right now, that's just not the case. I think interest rates are probably going to, creep a little bit lower here in the short term. And I don't think the Fed's going to raise interest rates until maybe the latter half of 2022. And again, the Fed doesn't actually control the 10-year note anyway. So this is more based off of market participants, agreeing on prices. So I think we're fine on interest rates. I think interest rates will continue to remain, kind of depressed and will probably trend a little bit lower over the near term there. RINF. Okay, so this is a inflation expectations ETF that's put together, and it's basically the spread between tips and treasuries. And so it kind of gauges where the inflation expectations are. And you can see, right, inflation expectations went rampant over the past like 12 months. So ever since we kind of bottomed out there, this is right after that huge drop from COVID, the COVID crash, the inflation expectations really ramped higher as like commodity prices spiked through the roof, lumber, copper, oil, all those things, agriculture, corn, soybeans. And so this is one of the things whereas I've said in the last few webinars, and when I talk to people kind of individually, and everybody's like, "Oh my gosh, aren't you super worried about inflation?" And like, I for the past few months, I kind of felt that it's the inflation trade was a little bit overdone. I think it was great during this time period if you were in those asset classes. And oil continues to kind of make new highs right now, but everything else has come down significantly. And so you can see that inflation expectations, that tips treasury spread, right? It peaked here, a couple months ago and has been consistently going down. Now it's not to say that it couldn't, catch a bid and continue to go higher here. I don't think it's going to run rampant like a lot of people do. I think the thought process behind, the kind of the money printing and inflation is a little bit over exaggerated. There's a lot of other forces that have to be in place for inflation to kind of take hold. And I don't think all those forces are in place right now, especially if, some of the emerging markets, show some lower growth in the near term. So I think we'll be okay from an inflationary aspect. And this clearly shows that, inflationary expectations has kind of stalled out for the time being. And if we look at some inflation sectors across the board, we kind of see the same thing. So this is actually a commodity index is the top line here. Okay. And so this is, a number of different commodities all put into an index and the prices of those going all the way back to 2006. And then this is the RSI, it's a relative strength index, momentum indicator. And this is a really simplistic way to use it. But essentially, when it crosses above the blue line, people can make the argument that it's overbought. And when it crosses below the green line down here, it's oversold. So over here, make the argument that it's overbought, kind of overvalued. And then when it gets really depressed, that it's undervalued and, a good time to buy. Again, that's a very, very simplistic approach to RSI. But if you look at the time periods when commodities became significantly overbought, so really spiked up, I circled all those, and you can see anytime commodities get significantly overbought like that, we do have those, pretty significant corrections. So I think it would be a little bit of a anomaly for commodities to be this overbought here and to continue to go higher. And so that's why it's another reason why I think, I think the inflation trade, the commodity trade might be over for a short period of time. Not to suggest that it can't go higher. I just think that as of today, I wouldn't bet that, hey, commodity prices are going to be significantly higher a month from now or 2 months from now. I think that argument was great 6 months ago, 8 months ago. I don't think that we're in that boat currently. So I think you'd have to see a correction in commodities before we'd see another huge push forward. So, and if we look at some of the commodities, like here's copper, copper's had a decent correction, ever since basically mid-May there, copper has come down quite a bit. We look at lumber, obviously lumber prices got all the way up to like $1,800, which is just absolutely insane. Lumber's come down all the way to like $700. I mean, still up a ton. I mean, it was down, I think it was at like what, 280 or so, like 12 months ago, but it's come down quite a bit. And so when you look across the spectrum at commodities of copper, of lumber, here's home builders, another pullback here. Obviously this isn't specific a commodity, but it's within home builders within that space, in the sense of what they're using. And home builders have had a big correction, and obviously everyone knows what's going on with the real estate market right now. With real estate, housing prices continuing to go up, significantly on a month over month basis. But home builders, has had a pretty big correction there. I mean, all the way from, just under $80, got all the way down to, almost the mid 60s there. So I think when you look across the board at commodities, they all have kind of corrected, have come down quite a bit. The one is, this XLE. So this is actually energy companies, not the price of oil. But energy continues to kind of make new highs. That's the one that, kind of the redhead stepchild right now in the commodity space that, is continuing to kind of go up and make new highs. So we'll see if that kind of follows suit, and starts to correct a little bit, or if that continues to creep up. But again, commodities overall as a whole have definitely started to correct. So I talked earlier about the whole, yes, the S&P 500 is at all-time highs, right? And so typically when people, you hear that in the news, you automatically assume like, oh, hey, that's great. Like the S&P 500 is at all-time highs. Everything's moving forward. Life is grand. Great time to, put your, pedal to the metal, go full speed in investments. But some of the underlying conditions aren't really showing the same thing. So one thing, there's kind of two statistics that when you're looking at this chart. So the top chart, obviously the S&P 500. Bottom chart is the stocks, percent stocks making 13-week new highs, right? And you can see the S&P 500 is going up, but the number of stocks that are making new highs is going down, and so that doesn't really show a whole lot of confidence in the underlying index move, right? And how that can take place, right? So most people, when you think about the S&P 500, obviously there's, approximately 500 stocks in there. I think it's actually like 505 right now, but it's not equally weighted. So yes, there's, approximately 500 stocks in there, but each stock doesn't have the exact same weighting. So you have something like Apple that makes up 5.5%. Microsoft makes up 5.3. Amazon makes up 3.9. Facebook, a little under 2.5. And then Google makes up about 4%. So those 5 stocks, Apple, Microsoft, Amazon, Facebook, and Google, make up 21% of the S&P 500 from a weighting aspect. And so, yes, the S&P 500 is making new highs, but the majority of stocks are not participating. I think over the past 3.5 weeks, the S&P 500 is up like 3.5%. The average stock in the S&P 500 is flat, and it's because those stocks that I named off, the Apple, Microsoft, Amazon, Facebook, Google, all of those stocks are up about double digit over the past that 3.5 week period. And those 5 stocks make up 21% of the index. So those 5 stocks are up quite a bit. None of the other stocks are participating. Not that none of them are, but the majority of them are not. And that's a little bit concerning. If the market's going to continue to, march forward and be a really, strong and make, new highs, we really need to see more stocks participating in the uptrend. So if you're in an index fund, if you're in just, SPX, just the S&P 500 index fund or any other, large cap growth index fund, you're fine. You're participating because those are built to match the index. But if you're in more specialized fund or in individual stocks, it's been a little bit more of a challenging environment because, again, if you're outside of those top names, you're just not moving forward as much. And so I want to kind of take a look at, in this presentation, in the past, when that happens a little bit. So this one is XLF. So this is financials. I'm just going through a few other sectors. Financials have completely stalled out. We were pretty heavy in financials from basically January through like June. We just started to kind of sell financials, and they had a really good run. Financials are more value oriented stocks as opposed to growth, and value was kind of dominating growth for the majority of the year, but that relationship has kind of changed. And it's really just changed because of those Apple, Microsoft, Amazon, Facebook, Google, those stocks, which are all growth stocks. And then again, you see that the percent of stocks making 13 new week highs in financials has just completely fallen off a cliff there. So financials are not continuing to move forward at all. You look at technology, NASDAQ, has continued to, march on as well. But, number of new stocks not really participating as much. NASDAQ's been pretty resilient. I think a lot of people really thought it was going to roll over more, myself included, and it still might, but, it's being dragged by those stocks. So A few of the stocks are pulling the Nasdaq forward. So we'll see what kind of happens with that. So this is what I was talking about earlier. Growth versus value. Okay. So two kind of areas of the market, how stocks get divided up, growth versus value. And growth are going to be, typically your more, the growth oriented companies and technology companies, things of that nature. Value is going to be more, financials, utilities, things like that. So what you can see here is what we do is take growth and divide by value. VOOG is just a growth index fund through Vanguard. And then VOOV is a value index fund through Vanguard. And so if the line's going up, growth is outperforming value. If the line's going down, value is outperforming growth. Doesn't mean that they're both going up or both going down. It just shows, hey, which area of the market is outperforming, growth or value. And you can see like growth dominated in 2020. And then once we got into kind of that November time period, value really started to take hold, and value basically from then all the way through like kind of mid-March is when value really started to outperform. And it's been a while since value has like really outperformed growth. And it had a really, really good like 5-month time period. And then growth right here. And so the same thing that's going on in the market right now with those FANG stocks I was mentioning earlier, outperforming and holding the market up. Same thing happened in April. There was about a 2.5 or 3 week period in April where the Apple, Microsoft, Amazon, Facebook, Google, those companies kind of dominated. All the other companies kind of stalled out. And so growth really had a nice run for like a 3 week period. And then everything kind of got back on track. And even during this time period, there's, a lot of people were thinking, hey, market breadth, overall market health had really stalled out. Yes, the market's moving forward, but is breadth so weak that we're going to see the market roll over a bit? And what happened was the rest of the stocks started to participate again. So all those other companies in the S&P, not all of them, but the majority of them in the month of May, really started to they had a really good month. And so they all kind of started to participate. It was a little bit more of that kind of just ebb and flows in the market. And then we're seeing it again. And it's not always just the FANG stocks that, maybe are outperforming as to why growth outperforms value. But this little spike here was, and this spike here is. So if you're outside of those 5 or 6 stocks, you're just not seeing much growth in the market right now. And so the question kind of remains is, will the rest of the market catch up? As all those other stocks that are in the S&P 500 or, whatever index you want to, talk about, are they going to start moving forward, or is the market going to turn over a little bit? Because the market can only be carried by those 5 or 6 stocks for so long. At some point, those stocks are going to run out of steam. And if those stocks run out of steam and then those other stocks aren't moving forward as well, then that's when we'll see a little bit of a correction. Now, how big is it going to be? One, who knows if we see one. We could also just trade sideways for a few months. I don't think the market can go up for the next 3 months based on just those 5 stocks alone. I don't see that being a plausible case. I mean, I guess anything can happen, but it's just not something that you're typically going to see. So, one of the things that's going to happen is that maybe we kind of trade sideways for a few months, or we have a kind of a little bit of a correction. And that's kind of where my head has been for the past 2 months. And I've been mentioning that on the last few webinars, that I really thought we'd see like an 8 or a 10% correction, that it would be pretty quick, but nothing too crazy. And then we probably get back on track. And it's kind of where my head still is. That's really what I think is the most plausible. And some other things in the market that are going on kind of point to the equity market stalling out for a little bit. So we'll see what happens. I think, like I said, there's some things that are pointing to just the equity market stalling out for a little bit. So, and again, this goes to, here's the S&P 500 at all-time highs, right? So if you look on the right side of the chart here, we can see all these little candlesticks here, right? And these are weekly. Each candlestick represents 1 week. And you can see this is going up. And remember that I said earlier, the S&P 500, not an equally weighted index, okay? So those 5 stocks that I've mentioned a handful of times make up about 21% of the S&P 500. So those are pulling the index. So what happens when we look at the S&P 500 on an equal weighted basis, meaning we take all the stocks in the S&P 500 and equally weight them, meaning well, 5 stocks can't make up 20%. So that's what we're going to do. RSP, it's an ETF. It's an S&P 500 equal weighted ETF, not showing the same strength, right? So again, here we are with equal weighted, flat, okay? And again, we'll go back, same time period, non-equal weighted, just normal S&P 500, up, okay? So we've seen the equal weighted completely kind of flatten out here, right? Just like it did, if you look here, right before that crash for COVID, you know, if you go back, S&P 500 was up a little bit, okay? So we're kind of seeing the same, maybe in the ninth inning of, you know, this current, you know, market cycle. And again, when I say that, I mean like in a really short time period. I'm not talking about like, hey, we're at the end of a major cycle and we're going to have this major crash. I just don't see that happening based on some of the other things going on in the market. But again, I think it would be a really, you know, prudent thing for the market to have a little bit of a correction. We haven't really had anything major since last October. You know, it was here's, you know, this is last September, October. I mean, ever since then, it's been pretty much straight up. So this, again, equal weight kind of flat out. And then this kind of shows it comparatively. The bottom line is the RSP. So the bottom line is the S&P 500 equally weighted. So each stock is the exact same percentage in the index. The top line is the S&P 500. So it's exactly how it's made up. So it's those FANG stocks make up 21%. And you can see I drew these blue lines when the equal weighted begins to level off or fall, but the S&P continues to kind of make new highs or go up. And you can see, right, a little bit of a correction here. This is August of 2015. So this was like a 10% correction here, right there. And then, you know, obviously the COVID crash here. So again, equal weighted flat line, S&P 500 making new highs. And then here we are here, equal weighted, you know, flat line to maybe slightly down there, S&P 500 at new highs. So, you know, again, it doesn't mean we're going to have, you know, any sort of a pullback. I think it's either trade sideways for a few months or a pullback. I just don't think the S&P can continue to make new highs unless those other stocks start to participate. We really need to see kind of like the Russell 3000 specifically kind of, you know, continue to move forward if we're going to see the overall market, you know, stay healthy and move forward. So we need to see more stocks participating. And then, you know, I showed you guys kind of the RSI earlier. You know, the top line is the S&P 500. Again, bottom line, you know, RSI, it's kind of the same thing, that it's a momentum indicator that people use. And really what you want to see is if, you know, you want to see the momentum indicator confirm if the S&P 500 is making new highs, you want to see the RSI making new highs for that specific time period as well. And, you know, I again put little blue bars when the S&P continued to go up, but RSI was falling during that same time period. And again, it coincides with, you know, pullbacks, drawdowns in the S&P 500. Little bit, there's, you know, pretty short-term time period I looked at just the past like 2 years, but you can go back over the past 5-10 years and it's kind of the same thing over and over. Just not seeing, you know, a lot of confirmation in the indexes, you know, to feel really comfortable saying, hey, I think the next 2 months are going to be great. It just, you know, I think the data does show, you know, something else. But again, if the other stocks start to participate, then, you know, obviously that'd be great. And we, you know, that would change my opinion on that. Just, again, haven't seen that just yet. You know, this is something I've talked about in the past. This is, you know, the U.S. high yield bonds, the option adjusted, the credit spreads between high yield and treasuries. And as you can see, is the spread widens. So as the spread increases here between high yield and treasuries, you know, it coincides with market drawdowns. So this is kind of like heading into the first quarter of 2016. You know, we had a 12.5% correction. This was the fourth quarter of 2018. This was obviously COVID. This is why I don't think we would see a major, you know, correction just now, is because I don't think the credit markets are really signaling that. I think if this was spiking, if this was starting to creep up more here, then I would say, hey, maybe there's a little bit more to pay attention to. And we're just not seeing that in a lot of areas of the credit markets. Now, maybe a few, but nothing huge to get too concerned about. And again, this is, as credit spreads. So the bottom line is credit spreads. Top line is the S&P 500. So as credit spreads increased, we saw those drawdowns, right? Credit spreads started to increase, drawdown. Credit spreads showing signs of weakness. The bond market's, showing some signs of weakness there for equities. And yeah, we saw those drawdown. And we're not seeing that. We're just, this is continuing to make really, really, really low numbers here. And I gauge this on a weekly basis. So I input this every single week, look at where credit spreads are. And they're lower this week than they were, 2 weeks ago. So just not seeing any major spikes there yet for me to say, oh, wow, something really concerning. This is treasuries, TLT, just, 20-year plus treasuries. And money pours into treasuries typically when people are a little concerned about the market. There's a lot of reasons too, other than just that, but it could be, searching for yield, depending on where interest rates are and things like that. But, and I've talked about this, I think 2 months ago is the first time I said, I think treasuries are starting to find a bottom because treasuries got absolutely crushed. Bonds have had a rough year. Bonds, especially the first 4 months, were down like 3.5% on the year or something like that. And treasuries themselves were down. I think it was like 7. So treasuries got hit pretty hard and they've really started to come back. Treasuries have started to come back. And so that, again, is it a precursor to a pullback or is it that treasuries were just really oversold? Because treasuries did get pretty oversold. It's pretty uncommon to see treasuries down 7%, in a 3 or 4 month period, unless there's major, concerns going on in the credit markets, like, January of 2009. Usually just don't see treasuries get hit that hard. So, I think it's probably a little bit of both. I think treasuries were a little bit oversold, but I'm in the camp that I do think the equity markets will have a little bit of a pullback. I think we're in store for probably a 10% pullback. That's just based off of everything that I look at. So we'll see. I feel like I've been saying that for 2 months and it hasn't happened yet. So we'll see. And then this is high yield versus treasury. Okay. So HYG is high yield. TLT is the chart we were just looking at. So treasuries. And so we take high yield, divide it by treasuries, and we want to see which one's outperforming. Okay. So if the line is going up, high yield is outperforming treasuries on a relative basis. If the line is going down, treasuries are outperforming high yield on a relative basis. Again, it doesn't mean that they're both going up or down or whatever side. It's comparing one versus the other. And you can see again, like this is like 2008, right? So treasuries outperformed high yield significantly, which would make sense because treasuries are, more of that safety money. And so treasuries were outperforming high yield in 2008. During this time period, this was 2011, U.S. debt got downgraded. Right here was that August of 2015 time period, first quarter of 16, and then from the fourth quarter of 2018, when the market corrected 20%, all the way to the bottom during the COVID crash. All those time periods, treasuries outperformed high yield, right? This is where we're at. So high yield, since the bottom of COVID, outperformed treasuries pretty drastically. And then that relationship has recently changed. And so just makes you wonder, where are we at from a risk cycle aspect? Are we going to kind of have that quick 10% correction thing? Is there something a little bit deeper on the horizon? With all the data just going, off of everything that I went through, just, not getting confirmation in the S&P 500, kind of those all-time highs, just not seeing a ton of participation there with treasuries outperforming high yield. Those make me think that, there's a little bit more risk in the market than we've seen for a little bit. But again, credit spreads aren't signaling anything too major. So I think if we saw a correction, it'd probably be fairly short-lived and most likely would, after we got back on track, would be just fine. If credit spreads start to spike during that same time period, then I think it'd be a little bit more of a, hey, you really want to look for more safety on the investment side. So we'll see with that one. Kind of a quick recap here, just inflation expectations certainly have come down, and I thought that was really kind of overdone. I thought it was, ever since kind of mid-April or so, just how people were talking about where inflation would be 3 months from now. I didn't see the same thing. And, all of the commodities have had, have had some pretty sizable corrections other than oil. So again, commodities overall continue to trend down. S&P 500 all-time highs, but not as strong of a move as you would like to see. We'd want to see more participation to say, hey, the next 2 to 3 months look great. Just not seeing that. Equal weight, not confirming those all-time highs. Growth and technology are what is keeping the indices moving forward. NASDAQ has been incredibly resilient, and growth has been, but it's really been based off of those 5 or 6 stocks I mentioned a few times throughout the webinar. With all that being said, though, credit spreads, again, not showing major issues. Treasuries finally outperforming high yield. It's been a while. And is it just because they were a bit oversold, or is it more of a risk-off signal? I think it may be a little bit of both. And then I've said this for the last few months. I expect a choppy summer. Haven't seen it yet. Time will tell, but I really do. I think the next 2 months, I would be surprised if we saw, if the next, 10% move was 10% higher before we saw, 8% lower or 10% lower or something like that. I would be surprised by that, but we'll see. So that's kind of the quick recap there. Here's the disclosure slide again, and then just open it up for questions to see if anybody has any questions for anything.